Welcome to The Explainer. Ever get that feeling that the vibe is changing? Well, today we're jumping into the mind of a seasoned trader who thinks the stock market's big party might be winding down. They're seeing some serious storm clouds on the horizon, and we are going to break down exactly what they're seeing and, more importantly, what they're planning to do about it. Let's get into it.
You know, this one line right here says it all. This isn't about someone yelling that the sky is falling. Nope. This is about noticing subtle changes, feeling that shift in the financial weather, and getting ready for what might come next. It's the kind of Lang-Ching, calculated thinking from someone who's been around the block a few times and knows that markets don't go up forever.
And really, that's the multi-billion-dollar question, isn't it? After such an incredible run-up, are the economic engines that got us here starting to sputter? This trader is betting that, yeah, things are looking shaky. So we're going to dig into not just why they feel that way, but also take a peek at the exact playbook they're putting together to navigate it. All right, here's our roadmap. First, we'll talk about that shift in the wind. Then, we'll look at the specific gathering storm clouds on the macroeconomic front. After that, we'll see how we're reading the market's signals. And then, the really interesting part, we'll open up this trader's bearish playbook. Finally, we'll wrap it all up with what this means for you. Okay, so let's zoom out to the 30,000-foot view. This trader's concern isn't based on just one thing. It's about a whole bunch of different pressures all building up at the exact same time. It's the kind of setup that could create what they call a perfect storm. And here they are. Now, the key here isn't just looking at this list. It's understanding how these things are all connected, right? A war in a major oil region can send oil prices through the roof. Higher oil means it costs more to make and ship, well, everything. That feeds directly into inflation. Throw in some tariff threats, which messes with supply chains, and you get even more inflation. And then you've got the big one at the bottom, rising Treasury yields. Think of that as the financial gravity that starts pulling money out of the stock market.
Let's double-click on that last point, because it is absolutely crucial. Imagine you're managing $1 billion fund. You can put your money in stocks, which have been great, but are, risky, or you can put it in U.S. government bonds, which are basically the safest investment on planet Earth. For a long time, bonds paid almost nothing, but now that guaranteed payout, the yield, is getting higher. Suddenly you're thinking, why am I taking all this risk in stocks when I can get a pretty decent guaranteed return over here? Big money starts to move, and that flow of cash out of stocks and into bonds acts like a giant anchor on the market.
So, we've got the storm clouds gathering, but what are the markets themselves actually telling us? Let's dive into the charts and see what signals this trader is picking up on right now.
And the number one word that comes to mind is fragile. This trader believes that the recent run to all-time highs was built on a pretty shaky foundation. It's like a Jenga tower that's gotten way too tall. All it takes is one little push, one of those macro pressures we just talked about, and the whole thing could start to get really wobbly.
So what does wobbly look like in actual numbers? Well, the trader is getting ready for a pretty typical market pullback, which is about a 10% drop from the highs. Now, let's be clear, this isn't a prediction of some 2008-style meltdown. But hey, a 10% drop is still a 10% drop. That can put a serious dent in your portfolio if you're only prepared for sunny days. The big unknown is how it happens. Does the market just slowly bleed out over weeks and months in a painful, grinding sell-off? Or do we get a sudden, sharp panic move where the floor just drops out from under us in a few days? The truth is, nobody knows. And it's that very uncertainty that makes it so important to have a plan in place before it starts. All right, we've identified the risk. Now for the solution. This isn't about running for the hills and stuffing cash under the mattress. Nope. This is about making a strategic shift, moving from offense to defense, and using some really specific tools designed for exactly this kind of environment. So let's open up that playbook. And the main tool in this new playbook is options. Now, if you're not familiar with them, the easiest way to think about options is like buying insurance for your stock portfolio. You can pay a little bit of money to protect yourself against a big drop. But here's the really cool part. You can also structure them to profit when the market goes down. And that's exactly what this trader is starting to do.
Okay, I know this table looks a little intense, but stick with me. It's basically a cheat sheet for 3 different ways to bet against the market. First up, the call credit spread. This is your go-to if you think the market is just going to drift lower or even trade sideways. You're basically selling a lottery ticket to someone who's betting the market will scream higher. If it doesn't, you just pocket their money. Next, the double calendar. This one is wild. It's not just a bet on price, it's a bet on fear. This trade is designed to make money when volatility, the market's fear gauge, explodes. It thrives on chaos. And finally, the put broken wing butterfly. This is the surgical strike. You use this when you think the market will fall to a very specific price zone. It's a low-cost bet with a potentially massive payoff if you get it right.
So you're probably asking, why bother with all these complicated strategies? Well, it comes down to three massive advantages. First, defined risk. With these trades, you know the absolute most you can possibly lose before you even place the trade. Your risk is capped. Second, they're capital efficient. You can control a huge market position with a relatively small amount of money. And third, and this is the secret sauce, they are built to benefit from rising volatility. When people panic, fear goes up, and these strategies are designed to turn that market fear into potential profit.
So look, the goal here isn't to get you to run out and start trading bearish option spreads tomorrow. The idea is to pull back the curtain and show you how a pro thinks when the environment starts to change. So let's boil this all down to the most important takeaways.
So let's tie this all together. You've got these big global warning signs flashing. You've got a smart, experienced trader who is not ignoring those signs. And what's their reaction? It's not panic. It's preparation. It's about calmly shifting strategies, using tools that have a built-in safety net, and getting ready to navigate a storm instead of just getting caught in the rain. It's a total masterclass in proactive risk management.
And so that brings it all back to this final question for you. You've just seen a really compelling case for why a storm might be brewing, and you've seen the playbook a professional is using to get ready. The real takeaway isn't to copy these exact trades, but to ask yourself, am I prepared for a change in the weather? It's definitely something to think about. Thanks so much for watching The Explainer. If you got some value out of this breakdown, do me a favor and hit that like button. And make sure you subscribe so you don't miss our next deep dive. See you then.